6 undervalued dividend stocks near their 52-week lows. We're going to look at their historical performance. We're going to jump into their dividend safety, looking at their financial metrics. And as always, we're going to jump into the valuation models, getting to the intrinsic value and the acceptable buy price given our investor margin of safety, whilst also looking at the upside that Wall Street are predicting over the next 12 months. So let's jump straight into stock number 1, which is MO Altria Group. Now 2013, they were down around 8.5%. We can see them near their 52-week lows with a yield of just under 10% at 9.45 and a forward PE at 8.37. Now, if you've been holding this over the last 10 years, you would be up around 11%. Now, bear in mind that doesn't include those dividends reinvested, but their share price all-time high was quite some time ago, summer 2017, at around $76. So let's take a look at those financial metrics. Straight away, dividend safety, 55 score borderline safe, 73 billion market cap, a large cap company. Now, in terms of recessionary metrics, for those that see a recession coming soon, they increased the dividend during the last recession, 07-09, below average growth of negative 50%, bearing in mind this was below the average of companies in the S&P, sitting around negative 12%, but they completely destroyed, outperformed the S&P, negative 20% versus the S&P 500's negative 55%. Dividend growth, well, actually not too bad in my opinion. I always advocate as a minimum 4% on the channel to keep up in line with inflation. The fact that last summer they increased it in line with inflation at 4.3%, whilst also offering significant dividend yields of around 9 to 10% is fairly positive. Over the last 5 years, 8%, again another positive in my opinion. Over the last 20 years, slightly underwhelming at 2%. And when we take a look, they are a dividend king. They have increased those dividends for 50 years or more. Now, let's take a look at dividend yield theory. Now, for those that are new to the channel, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, bearing in mind we're not looking at any of these models in isolation, and we will draw conclusions towards the end. Likewise, another sign, forward PE 8.2 versus the 5-year average of 9.5. Sector PE, well, it is significantly lower at 8.2, with consumer staples coming in at 19.3. Now, regular viewers know that when we look at the payout ratios, we tend to fixate on the free cash flow payout. The reason for this, earnings are susceptible to manipulation by management through accounting, and we have gone through a significant number of examples on the channel explaining this and showing some strong examples from different companies. Below 85% is what we target for tobacco companies, and we can see for the majority of the last 10 years, it has been well below that, especially in the last few years. 2023 is expected to be around 61%, 2024 around 83%, so I would expect at least keeping up in line with inflation with that dividend increase this summer. Free cash flow per share, well, $2.12 in 2013, $5.02 in 2022, more than doubled that over the last 10 years. 2023 expects to be a very strong year of above $6 per share on the free cash flow, so looking very strong for the Altria Group. Sales growth, now we do understand this industry does tend to have declining sales, and we can see that here. It is struggling to even keep up in line with inflation, and we look for around 3 to 7% for steady moderate growth. We can see in 2022 negative 2%, 2023 it is expected to be negative 1%, so do understand this about the tobacco industry and more particular with Altria Group. Total sales then 17.7 billion in 2013, 20.7 in 2022, and we can see pretty much in line expected in 2023. Now, when we do take a look at the shares outstanding, they have essentially done share buybacks, reducing their shares outstanding by 10%, going from 2 billion to 1.8 in 2022. Bearing in mind, this is very positive for investors as it returns excess cash to their pockets. Now, when we take a look at ROIC, return on invested capital, one of my 7 golden dividend metrics, I look for 10% or more, gives me faith that management are able to effectively allocate their capital, and Altria Group have consistently done that, as we can see, and in fact from 2018's decent 22%, they have increased it. 2023 expected to be even higher at 51%. Now, margins, operating and free cash flow, very, very strong. Not only is it above that 25% on the operating margin, but it continues to increase. 60% expected in 2023, and a very similar story to be told on the free cash flow margin. 44% in 2022, 54% in 2023. Now, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. For those that are new, it signals two things: a balance sheet strength as well as dividend safety. And these show us the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 1.85. 2023 expected the similar, well below that 3, and in conjunction with their free cash flow payout, which is very, very strong, below the maximum we look for. In my opinion, Altria's dividend seems to be safe for the foreseeable future. Now we can jump into the valuation. And as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of this content as it drops. It lets me know you enjoy the content, and I'll continue to bring out the content that the community loves. Now, typically on the channel, we run through every single model: Graham's valuation, multiples, dividend discount, the discounted cash flow. But for today's episode, we'll jump straight into the intrinsic value. And for today's episode of Altria Group, the intrinsic value is just the average of these four models, coming to $52.90. Now, the current pricing around $41.48. Typically, we start off with a 10% margin of safety. If we believe it has a wide moat, strong financial metrics, good forward-looking data, we can see it is still a buy at 15% up to $45, and at 20% around $42. If we go to 25, we can see it's not a buy just yet. So right now we expect around a 20% margin of safety on Altria Group. In terms of what Wall Street expects over the next essentially 12 months, we can see they see some nice upside of around 15%. So in conclusion, for Altria Group, we see around a 20% margin of safety based on our estimates and judgments, with Wall Street expecting 15% upside over the next 12-month period. Now, this is one that I have bought, so it is on my radar, and if it does come lower, I will continue to add, as I do believe that intrinsic value is fairly high, and we should see the price of this company go up over the next 12 months. Now we then move into the second stock, which is Humana, ticker symbol HUM. Now this is one that is on my radar, on my watch list, and it is one I will be looking to add. We can see it towards its 52-week lows with a yield of just under 1%. Forward PE sitting around 16. 2023, they were down around 6%. Now, when we do take a look at the last 10 years, we can see it is in fact up 373%, excluding those dividends reinvested. So it does look to be a very strong company, and we can see its all-time high around $100 higher than the current trading price at the back end of 2022. So let's jump into the dividend safety. 99 score, very safe, 56 billion market cap, large cap company. Recessionary metrics, well, they didn't pay a dividend in the last recession, plus 6.2 sales, above average growth, but they did underperform, underwhelmingly, the S&P with a negative 72% recession return. Dividend growth, what is not to love with this company? 12% last year, so we're expecting another dividend increase essentially next month. Double digits, 15% over the last 5 years on average, 12% over the last 10 years. Now, they have also been increasing those dividends for the last 11 years, which is positive to see. Now, dividend yield theory, we can see a sign of undervaluation, 0.77 versus the 5-year average of 0.68, and a similar story to be told with that forward PE, 15 sitting below the 5-year average. When we compare it to the health sector, care sector at 18.2, Humana sits at 15. Now, focusing on that free cash flow payout, below 60% is what we typically like to see, gives us faith that management are able to offer those double-digit dividend increases. And we can see over the last 10 years, in fact, it has been well below 60%. 2022 at 11%, 2023 at 9%. So this is one that I am very certain that they will offer another double-digit increase next month. It is one that I do like for dividend growth and is definitely on my watch list. Now, free cash flow per share, $8 in 2013, $27 in 2022, so it has increased by more than 3 times. Yes, it is inconsistent, so do note that some years strong growth followed by some strong negative growth. 2023 expected to go even higher at $40. Now, sales growth, very nice to see, nearly double-digit increase to the top line every single year, 10% in 2022, 12% expected in 2023. Now, when we look at these sales numerically, 41 billion in 2013, more than doubled over the last 10 years, 93 billion in 2022, and they're expected to break that 100 billion sales barrier in 2023's report. Now, shares outstanding, they also do share buybacks. This is lovely to see alongside those double-digit dividend growths. 159 million shares outstanding in 2013, 127 in 2022. Now, focusing on the ROIC, well above the 10% consistently, 16% in 22, 17% expected in 2023. So there is a lot to love with this company, some very strong financial metrics. Now, one area that they do lack is that operating margin. We can see it is slacking below that 12%. The last few years at 5%, the same expected in their 2023 annual report. So it is something just to be aware of. If this does continue to get squeezed, it could be a red flag indicator, but it is one that we will be closely monitoring. Free cash flow margin, again, something similar to note there, although 2023 it is expected to be at that 5% minimum target. Now, net debt to EBITDA, fantastic. This is the best you could ever get, consistently at 0, meaning they have a phenomenal balance sheet. We understand now that dividend safety score being very safe, and it means it wouldn't even take them one day to pay off all of their debt net of cash on hand. So let's jump into the valuation model then, and as always, you can grab a copy of the valuation model. Click on that pinned comment below. You can get to the intrinsic value and acceptable buy price of companies in your own portfolio or even those on your watch list. So let's start off with a margin of safety of 10%. We can see it is a buy up to $480. At 15%, around $453. So it is a few dollars shy of a 15% margin of safety. So you could argue right now it is trading around that 15% MOS level. In terms of Wall Street and what they expect, well, we can see here some significant upside over the next 12 months. With Wall Street expecting around 30% upside. So in conclusion, for Humana stock, this is one that is on my radar. It may very well likely be one I add next. I will drop a video on this if it is. And we can see in conclusion a 15% margin of safety, with Wall Street expecting around 30% upside over the next 12-month period. Jumping into the third dividend stock, we have British American Tobacco, BTI, currently trading around $30. As we can see, it isn't far off that $28 52-week low. Again, similar to Altria Group, a yield of just under 10% with a forward PE of 6.53. Now, 2023, we can see 25%. It wasn't the greatest year for BTI. It was hammered. The last 10 years, again, not great either, down 41% with its all-time high quite some time ago, 2017 at around $73. So let's take a look. We have a dividend safety borderline safe at 45, which we can analyze on the metrics. 67 billion market cap, a large cap company. Now, recessionary metrics, well, they increased the dividend during the last recession, positive sales, and outperformed the S&P with a negative 31% return. Now, 1% over the last full year, not the greatest, however, keeping up in line with inflation over the last 5 years, and 10% over the last 20 years is always positive when you are getting a very high yield. And another thing to note, they are 2 years away from becoming a dividend aristocrat. So dividend yield theory, it should come as no surprise. We see that sign of undervaluation with the yield above the 5-year average, and likewise on that forward PE sitting below the 8.6 5-year point. Now, when you compare it to the consumer staples sitting at 19.3, BTI is very low at 6.3, although just because it is lower than the sector PE, that is not an undervaluation signal. Free cash flow per share, well, it is one of the lowest in the tobacco industry, around the mid-50s or low 50s over the last few years. 2023 expected to be the same when the annual report comes out at around 51%. Free cash flow per share, well, 195, more than doubled over the last 10 years to 432, and 2023 we are expecting a very small increase to that previous year. Sales growth, unlike Altria Group, we do see some growth not only in 2022 but also expected in the 2023 annual report at around 7%. They have had some years of flat growth, but overall this is probably one of the best tobacco companies in terms of looking at their top line purely. Now, total sales, well, it has nearly doubled from 15 billion to 28 billion in 2022. One thing to note, though, their shares outstanding has increased over the period. They have done share buybacks, but they've also done share issuances. And overall, on a net position, your position as a shareholder would have been diluted over the last 10 years, as we can see by the shares outstanding count. ROIC, it is lacking, especially when you compare it to the Altria Group. We do look for around 10%. You can even bring it up to 15% if you are purely looking at tobacco industries, although it comes down to the investors' preference. 9 to 8% over the last few years consistently, although 2023 is expected at 10%. Now, looking at the margins, it is very, very strong, well above 25%, well above 20% on both operating and free cash flow, so no worries there. One thing just to note, the net debt to EBITDA, we can see it around that maximum of 3, although it is expected to come down to 2023 at 2.82. Now, when we jump into the valuation of BTI, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. We see a very high intrinsic value at $53 with the current price at around $30. So we already know the margin of safety will be quite high. At 40%, it is still a buy up to $32, and at 45%, it is still shy. So based on our estimates analysis, a margin of safety of around 40%. Now, when we look at Wall Street's forecast, they also see some nice upside. They see around 40% upside over the next 12 months. So in conclusion, for BTI, we see around a 40% margin of safety with around 40% upside per Wall Street. But always do your own due diligence before you invest. Also understand the risks with the tobacco industry, whether or not you do believe it is dying. We are seeing sales across these companies dropping, although it really does depend on how they do reposition themselves, with some of these companies targeting the cannabis industry, as well as those markets where they are essentially having growing revenues that we have discussed in in-depth detail videos of BTI and Mo in 2023. So now let's jump into the next dividend stock, and that is APD, Air Products and Chemicals. Now 2023, we can see they were down around 10.5%. It is trading to the mid to lower end of the 52-week range with a yield of 2.59% and a forward PE of 21. Now, if you've been holding this over the last 10 years, you would be up around 167% without those dividends reinvested, and we can see its all-time highs towards the end of 2022 and the beginning of 2023 at around $315, so it isn't too far off that point. So when we look at the dividend safety, score of 95, very safe, 60 billion market cap, a large cap company. Key metrics will increase the dividend during the last recession, below average growth, and had a near recession return of negative 52%. Nice increase last year of 8%, so we can see we are expecting a dividend increase this month. Double digits over the last 5 years, double digits over the last 20 years. Lots to love as a dividend growth investor, and we can see they are a dividend aristocrat. They have increased dividends for the last 25 years or more, and they are around 8 to 9 years away from becoming a dividend king. So dividend yield theory, talk to us. What is it saying? We can see a sign of undervaluation, 2.59 versus 2.25. Forward PE, 20.9 versus 24.8. And when we compare the sector PE, it is slightly higher than materials at 18.6. So when we take a look at the free cash flow payout, this is one of the reasons why we always look at free cash flow. 2022, you were to look at the earnings, 61%, you might be happy with yourself. Look at that. In 2022, they paid a significant amount more in dividends than they generated in free cash flow. And we can see 2023 negative, so we would expect their free cash flow per share in 2023 to be negative too. So let's take a look there, and we can see that 2023 is negative 6.39, and up in the period from 2014 to 2022, we do see it sitting very inconsistently. Some years growth followed by some years of negative growth, and this is one that if you do or are interested in, want us to take a look in more detail, we can do a full stock review analysis, so let us know in the comments below. Sales growth, 2015, they had a strong negative double-digit growth. And although we do note in 2021 and 2022 we see strong double-digit growth, over the period there have been many years where the top line has been flat. So numerically what we see, 10 billion in 2014, 12.6 in 2023. It's always good to understand the industries that you're investing in. If you are looking in the tech company, you would expect sharp increases year on year. If you're looking at more mature businesses, you would expect a different story. Shares outstanding, they have diluted your position, although it is very minimal, moving from 215 million in 2014 to 223 in 2023. So ROIC, around that 10% consistently year on year, 11 in 22, 9 in 2023. So it isn't too bad. It is sitting at that bare minimum that we do look for when we do want to invest in companies. Operating margin, well, it is fairly inconsistent, but still above the 12%, so that is positive. 23 at 21% is strong, and we do note the free cash flow margin has dipped in 2022 and 2023. So again, just something to keep an eye on. Red flag indicators when we do see this go into the negative, as well as the free cash flow per share, but it doesn't necessarily mean it isn't investable. You always need to look at the facts and figures behind. Net debt to EBITDA looking positive, 1.92 in 2023. 2024 expected to come down lower, which is below that 3 maximum. So it isn't the worst. We can see why that dividend safety looks to be very safe, as well as we can analyze that it does seem to have a fairly decent balance sheet. So what does the valuation tell us about APD? So let's jump into that. The intrinsic value then coming to the average of the three models used at $320, with the current pricing around $270. So a 10% margin of safety, we see a buy up to 287. At 15%, pretty much $1 or $2 above the current trading price. So right now for ADP, or APD in fact, we do see around 15% margin of safety. Now, what about Wall Street? What do they expect? Well, they see the share price to be very similar to the intrinsic value that we have calculated, with around 20% upside over the next 12 months. So in conclusion, for APD, Air Products, we see around 15% margin of safety based on our estimates and judgments, with Wall Street expecting around 20% upside over the next 12-month period. The next dividend stock that we have to analyze is ResMed, ticker symbol RMD. Again, this one 2023 down 19%. We can see a forward PE of 23 with a yield around 1.15%. Now, over the last 10 years, this has grown around 249% purely on share price. And summer of 2021, we see it near the $300 mark, nearly twice the current trading value. So dividend safety sitting at 70, it is safe, 25 billion market cap, large cap company. They didn't pay a dividend during the last recession. They did have a positive above average growth, and we also see them significantly outperform the S&P with a negative 16% return. 9% increase to the dividend in August, very nice to see. 4% over the last 5 years, which is probably the bare minimum I do look for. And 10% over the last 10 years is very positive, that double digits. And we can see they have been increasing those dividends for the last 10 years. So now taking a look at dividend yield theory, we see that sign of undervaluation, 1.15 above the 5-year average of 0.82, and the same for the forward PE, 22.7 below the 5-year average of 35. And when we compare the sector PE, it is slightly higher than the healthcare at 18.2. So what does the free cash flow tell us? So again, very similar why we do look at the free cash flow, 126 in 2022, 29 based on the earnings. So 2023, it was 46%. That is positive to see. 2024 expected to go lower. So again, very positive. We can see why that dividend does remain to be safe. Free cash flow per share, well, $2.19 in 2014, $3.81 in 2023. It is increasing, again, inconsistent, which is unfortunate. But over the next 12 months, we are expecting the free cash flow per share to nearly double. So that is a very positive sign based on the forward guidance. Sales growth, nearly double digit every single year, 18% in 2023. Very positive to see. This is a company that is growing, and we can see that purely based on the sales. 1.55 in 2014, 4.22 in 2023, so nearly 3 times their top line. And in terms of shares outstanding, they have diluted your position, but very, very minimal. It has increased by only around 3 million shares, so nothing much to note based on that. ROIC well above that 10% minimum, in the 20s nearly every single year. 2023 at 20%, very positive, giving me faith in management and their ability to effectively allocate their capital. Very positive on the operating margin, above the 12% as we can see. Free cash flow margin, again, we see it's pretty much straddling that in 2022, but 2023 it did rebound to a very strong percentage. Net debt to EBITDA, I always love this. It is one of the most underrated metrics, 0.99 in 2023, and it has consistently been well below 3, so we can see strong balance sheet plus dividend safety. So let's get into the valuation of RMD. And as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So the current price at 167, we see the intrinsic value of 197, 10% margin of safety at buy up to 178, 15% pretty much bang on the current trading price. So for RMD, we're looking around a 15% margin of safety, based essentially on the judgments and estimates. In terms of the upside, well, they see it pretty much around that current trading price, so they are looking at around 20% upside per Wall Street forecast. So in conclusion, for RMD, we're looking around a 15% margin of safety with around 20% upside per Wall Street over the next 12-month period. Moving on to stock number 6, we have AEE, Ameren Corporation, down 14% last year, trading towards the mid to lower end of the 52-week range, and we see a forward yield of 3.4% and a PE just under 17. Over the last 10 years, it is up around 103%, and we can see its all-time high in 2022 of just under $100. Dividend safety score 69, it is safe, 19.5 billion, large cap company. They did in fact cut the dividend during the last recession, around average growth during that period, and had a near S&P return of negative 60%. 6.8% increase last year, so we are expecting another increase next month. 6% on average over the last 5 years, but unfortunately over the last 20 years it has been 0% on average, as we can see that cut in 2008 to 2009. So they have been only increasing those dividends for the last 9 years. Dividend yield theory, then we can see that undervaluation sign 3.4 versus 2.68, forward PE 16 versus 21.4, and comparing to the utilities, it's pretty much in line with 16.6 for the sector PE. So in terms of the payout, typically, we've just been running through the free cash flow, but for utilities, it is a lot more volatile, so we're focusing on the earnings, below 75%. Has been pretty much below that over the last 10 years, 57 pretty much consistently over the more recent period, so that is positive to see. And then when we look at the earnings per share, $2.10 in 2013, consistent increases nearly every year and more than doubled over the last 10-year period, with 2023's report expected to be $4.40. So let's take a look at the sales growth, and we can see the last 2 years as well as 23 expected to be fairly strong. But again, you can argue the cyclicality of the industry, the volatility that we do see here. But again, it isn't a fast-growing company. And numerically speaking, 5.63 in 2013, 766 in 2022. So it has increased by around 40 to 50%. Shares outstanding, it is typical again of utilities to dilute your position. They aren't a company that dilutes it at a very quick rate, but the reason for this, as we can see here, utilities often rely on issuing equity to fund a portion of their growth expenditures. So moving on to the ROIC, for utilities, we do bring this down from the 10% to around 7.5% and above. We can see it has pretty much come down from that 2017 point, but it is sitting around 6% in 2023. Now, operating margin is positive to note. It is above the 18, 24 expected in 2023, so no real worries there. As always, the operating margin, the higher the operating margin, the higher the bottom line net income should be expected, and then it can in turn mean higher dividends paid out. Net debt to EBITDA, we do bring this significantly higher for utilities at 5.5. It is expected to be there pretty much bang on in 2023. The positive sign, however, is that in 24 it is expected to come down to 4.4. So let's jump into the valuation. As always, you can click on the pinned comment below to grab a copy, run through your own companies or on your watch list to get your own intrinsic value based on your own estimates and judgments, as well as your own acceptable buy price. So let's start off with a margin of safety of 10%, and we can see this comes to around $82.50, at 15% up to $78, and at 20% we can see pretty much a few cents shy of the current trading price. In terms of what Wall Street expect, well, they do see some nice upside at around 20%. So in conclusion, for AE, we see around 20% margin of safety based on the current value on our estimates and judgments, with Wall Street expecting 20% upside. As always, if you enjoy this content, this weekly episode, and you want it to continue, smash that like button, hit the subscribe and bell button so you are constantly notified of these videos so they drop on your doorstep every single day. And don't forget to click on the pinned comment below, grab a copy of the valuation model, get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list, or even if you want to rerun those that we just did today. As always, have a great day, catch you all on the next episode and take care.